Welcome to the second video in our advanced video on articleship training interviews at chartered accountancy firms. Today we're diving deep into the intricate world of auditing, taxation, and corporate compliance. This session is designed for those who have mastered the basics and are ready to tackle more challenging questions that will truly test your knowledge and analytical skills. We'll address advanced technical queries such as how to perform substantive analytical procedures during an audit and the nuances of transfer pricing in multinational taxation. We'll also explore complex scenario-based questions, including how to handle fraudulent transactions and discrepancies in financial records. Furthermore, we'll delve into intricate taxation issues, examining minimum alternate tax calculations and the implications of international tax regulations. This is your opportunity to showcase not only your technical expertise, but also your critical thinking and problem-solving abilities. So get ready to engage with these advanced topics and prepare for a successful articleship journey. Let's dive into first question. How do you perform substantive analytical procedures during an audit? This involves comparing financial data against expected results, which helps identify any discrepancies that may require further investigation. For instance, if I'm reviewing a client's revenue, I would analyze trends over previous periods and benchmark against industry standards. If I notice a significant variance, I would delve deeper to understand the underlying reasons. It's about using data to tell a story and ensure accuracy in financial reporting. Next question. Explain the process of transfer pricing and its importance in multinational taxation. Transfer pricing refers to the pricing of goods, services, and intangibles between related entities within a multinational corporation. It's crucial for compliance with tax regulations and ensuring that profits are allocated fairly across jurisdictions. Proper transfer pricing helps avoid disputes with tax authorities and ensures that companies pay the appropriate amount of tax in each country they operate, ultimately supporting fair competition and economic integrity. Next, how do you verify the valuation of inventories in financial statements? This is crucial for ensuring accuracy in financial reporting. To verify inventory valuation, I would first assess the method used, whether it's FIFO, LIFO, or weighted average. I'd then perform a physical count to compare actual stock levels against recorded amounts. Additionally, I'd review the valuation calculations, checking for any write-downs for obsolescence or lower market value. This thorough approach ensures that the inventory is accurately reflected on the balance sheet. Now, shifting gears to the next question, what is the process for consolidating financial statements of a holding and subsidiary company? Consolidation involves combining the financial statements of both entities to present a unified picture. I would start by eliminating intercompany transactions to avoid double counting. Then, I'd ensure that the subsidiary's financials are aligned with the holding company's accounting policies. Finally, I'd aggregate the assets, liabilities, and equity, presenting a consolidated statement that reflects the overall financial health of the group. This process is vital for providing stakeholders with a clear understanding of the company's performance. Let's address this question. How do you audit revenue recognition policies for a client? This is crucial in ensuring that the financial statements present a true and fair view. I would start by reviewing the client's revenue recognition framework, ensuring it aligns with applicable accounting standards, such as IFRS 15 or ASC 606. I would perform substantive testing, which includes examining contracts to identify performance obligations and checking that revenue is recognized when these obligations are satisfied. Additionally, I would analyze historical data and trends to assess the reasonableness of revenue estimates, ensuring that any judgments made are well supported. Now, moving on to next, explain the deferred tax concept with an example. Deferred tax arises due to temporary differences between the accounting treatment of income and expenses and their tax treatment. For instance, if a company recognizes revenue in its financial statements before it is taxable, a deferred tax liability is created. Conversely, if expenses are recognized for tax purposes before they appear in the financial statements, a deferred tax asset arises. This concept is vital for accurate financial reporting and tax planning. Now, shifting gears to the next question, how would you verify intangible assets and assess their impairment? Verification of intangible assets involves a thorough review of documentation, including contracts, licenses, and valuation reports. Assessing impairment requires a comparison of the carrying amount to the recoverable amount, often necessitating discounted cash flow analysis. It's essential to remain vigilant about market conditions and technological advancements that could impact asset value, ensuring that financial statements reflect a true and fair view of the company's position. Let's dive right into a scenario you might face. A client insists on not reporting a related party transaction. How would you address this as part of an audit? In this situation, it's crucial to remain professional and ethical. First, I would calmly explain the importance of transparency and compliance with accounting standards. I would highlight the potential risks of not disclosing such transactions, including legal implications and damage to the client's reputation. If the client still resists, I would document our discussions thoroughly and escalate the issue to my supervisor, ensuring that we adhere to the ethical guidelines set forth by our profession. Now, let's tackle another critical question. If you discover fraudulent transactions during your audit, what steps will you take to handle this? My immediate response would be to gather all relevant evidence meticulously. I would refrain from making any assumptions and ensure that my findings are based on factual data. Following that, I would report my findings to the appropriate authorities within the firm, maintaining confidentiality and professionalism throughout the process. It's vital to act swiftly but carefully, ensuring that we uphold integrity while protecting the interests of all parties involved. Next, you identify a major inconsistency between the client's accounts and bank statements. How would you approach this issue? First, I would ensure that I gather all relevant documentation, including the client's financial records and bank statements. Next, I would conduct a thorough reconciliation to pinpoint the discrepancies. It's vital to communicate my findings to the client transparently, discussing potential reasons for the inconsistency, whether it's an oversight or something more serious. My approach would be collaborative, aiming to resolve the issue while maintaining trust. Now, consider the question. While auditing, if you suspect that revenue has been inflated, what checks and procedures would you conduct? In this case, I would start by reviewing supporting documentation for revenue transactions, ensuring they align with invoices and contracts. I would analyze trends over time, comparing them to industry benchmarks. Additionally, I'd conduct interviews with relevant personnel to gain insights into the revenue recognition process. My goal is to ensure accuracy and integrity in financial reporting, safeguarding the client's interests. Let's dive into a vital question. If a client's GST compliance appears incomplete or incorrect, how would you rectify it? First and foremost, I would conduct a thorough review of their records to identify discrepancies. This involves cross-referencing their sales and purchase invoices against their GST returns. Once I pinpoint the errors, I would guide the client on the necessary amendments, ensuring they understand the implications of each adjustment. It's crucial to communicate the importance of timely corrections to avoid penalties, and I would also recommend implementing a more robust compliance process moving forward. Now, addressing the next question, how would you calculate MAT, minimum alternate tax, and handle its adjustments in subsequent years? To calculate MAT, I would start with the book profit and apply the prescribed rate, ensuring all adjustments are made as per the Income Tax Act. For subsequent years, I would maintain a meticulous record of MAT credits, advising the client on how to utilize these credits against future tax liabilities, ensuring they maximize their tax efficiency. Let's dive right into next question. Explain the process and implications of filing a rectification request under Section 154. Filing a rectification request is crucial when there's a mistake apparent on the face of the record. The process begins with identifying the error, which could be a computational mistake or an incorrect application of law. You then need to submit a formal request to the assessing officer, clearly outlining the mistake and providing supporting documentation. The implications are significant. Rectification can lead to a reassessment of tax liability, potentially resulting in refunds or adjustments. Now, let's tackle another question. How would you determine whether a specific transaction qualifies for capital gains or business income? This distinction is vital in taxation. The determination hinges on several factors, including the nature of the asset, the holding period, and the intent behind the transaction. If the asset was held for investment, it leans towards capital gains. If it was traded frequently, it may be classified as business income. Analyzing these elements is essential for accurate tax reporting and compliance. Let's dive into a crucial topic in international taxation. Can you explain the concept of place of effective management, POEM? POEM essentially refers to the location where key management and commercial decisions are made. It's a pivotal concept because it determines the residency of a company for tax purposes. If a company is deemed to be managed from a particular country, that country may tax the company's worldwide income. This is particularly relevant for multinational corporations as it helps prevent tax avoidance by ensuring that the profits are taxed where the actual management occurs. Now let's tackle another significant question. How would you analyze and mitigate the risk of double taxation for a client with international income? The first step is to conduct a thorough review of the client's income sources and the jurisdictions involved. I would assess the applicable double tax treaties and utilize methods such as tax credits or exemptions to minimize the tax burden. Effective communication with tax authorities and timely filing of necessary documentation are also crucial strategies to ensure compliance and reduce the risk of double taxation. Next question. What are the key steps in vouching fixed assets? This process is fundamental in auditing fixed assets. First, we start with identifying the fixed assets recorded in the books. Next, we verify ownership by checking the title deeds or purchase agreements. Following that, we ensure the existence of these assets through physical verification. Then we assess the valuation by reviewing the acquisition costs and any depreciation applied. Lastly, we confirm that the assets are appropriately classified and disclosed in the financial statements. Now, let's tackle another question. How do you audit related party transactions to ensure compliance with statutory requirements? The audit begins with identifying all related parties and the nature of their relationships. Next, we review the transactions to ensure they are recorded at arm's length. We also examine the disclosures made in the financial statements to verify compliance with applicable accounting standards. Finally, we assess whether any transactions require approval from the board or shareholders, ensuring all statutory requirements are met. Let's dive into a fundamental aspect of auditing. Explain the importance of the materiality concept during an audit and how to determine it. Materiality is crucial because it guides auditors in identifying what information is significant enough to influence the decisions of users of financial statements. It ensures that we focus on the right areas, allowing us to allocate our resources effectively. To determine materiality, we typically consider quantitative factors such as a percentage of total assets or revenue, alongside qualitative factors like the nature of the item and its context. Now let's tackle the next question. How do you plan an audit engagement for a new client? Planning is essential for a successful audit. It begins with understanding the client's business, industry, and risks. I would conduct a preliminary assessment, gather background information, and establish a clear timeline. Engaging with the client to discuss expectations and deliverables fosters transparency and sets the stage for a smooth audit process. Let's address an important question you might face. How do you ensure compliance with the Companies Act 2013 while auditing a private limited company? This is crucial because adherence to the Companies Act is fundamental to maintaining corporate governance. I start by thoroughly reviewing the Articles of Association and ensuring that the company's operations align with its provisions. I also assess the financial statements for accuracy and compliance with the prescribed accounting standards. Regularly updating myself on amendments to the Act is essential, as is conducting detailed checks on board resolutions, minutes of meetings, and statutory registers to ensure all legal requirements are met. Now, let's tackle another significant query. What are the penalties for non-compliance under the Income Tax Act for corporate entities? Non-compliance can lead to severe penalties, including fines that can range from 50% to 200% of the tax due. Additionally, interest on delayed payments can accumulate, and in severe cases, imprisonment may be imposed. It's vital to emphasize the importance of timely and accurate tax filings to avoid these repercussions. Let's kick things off with a question that dives right into the legal framework. Can you explain the provisions related to Section 185 and Section 186 of the Companies Act 2013? Section 185 primarily deals with the prohibition of loans to directors and their relatives, ensuring that the interests of the company and its shareholders are protected from potential misuse of power. It's designed to maintain transparency and accountability. On the other hand, Section 186 governs the investment by companies, detailing the conditions under which a company can make loans, guarantees, and investments. It emphasizes the need for board approval and limits to ensure prudent financial management. Next, let's address the question, what are the key differences between FEMA and FCRA regulations? FEMA, or the Foreign Exchange Management Act, regulates foreign exchange transactions and aims to facilitate external trade and payments, while FCRA, the Foreign Contribution Regulation Act, governs the acceptance of foreign contributions by organizations to ensure that the funds are not used for activities detrimental to national interest. Essentially, FEMA focuses on financial transactions, whereas FCRA is about the regulation of foreign funding to NGOs and other entities. Let's dive into a critical aspect of corporate finance. How do you calculate the borrowing limits for a company under Section 180 of the Companies Act? First, it's essential to understand that this section outlines the framework within which a company can borrow funds. The borrowing limit is typically determined by the company's total paid-up capital and reserves. Specifically, a company can borrow funds up to a certain percentage of its paid-up capital, which is often capped at twice the aggregate of its paid-up capital and free reserves. This ensures that companies maintain a healthy debt-to-equity ratio and do not over-leverage themselves. Now shifting gears to another pivotal question. What are the key considerations while conducting an audit for an NBFC? When auditing a non-banking financial company, it's crucial to focus on regulatory compliance, particularly with the Reserve Bank of India guidelines. Additionally, assessing the adequacy of internal controls, evaluating the risk of financial misstatements, and ensuring that the NBFC's asset classification is in line with the regulatory framework are all essential. Understanding the nature of financial products offered and the associated risks can significantly impact the audit approach. Let's dive into a pressing question. What steps would you take to automate compliance processes in a client's organization? Automation is pivotal in enhancing efficiency. First, I would conduct a thorough assessment of the current compliance processes to identify bottlenecks. Next, I would explore software solutions tailored for compliance management, ensuring they integrate seamlessly with existing systems. Training staff on these tools is crucial, as user adoption determines success. Additionally, I would implement regular audits to monitor the automation's effectiveness and make adjustments as necessary, fostering a culture of continuous improvement. Now, let's address another essential question. How do you ensure that the opening balances in the trial balance are accurate when joining a new audit assignment? Accuracy is non-negotiable. I would begin by reviewing prior year financial statements and reconciling them with the general ledger. Engaging in discussions with the client's finance team is vital to clarify any discrepancies. Lastly, I would conduct a detailed analytical review to ensure that the balances align with expected trends, providing a solid foundation for the audit. Let's address a scenario you might encounter. How would you address a situation where the client is not maintaining proper books of accounts? In such a case, my first step would be to engage in a constructive conversation with the client to understand their challenges. I would emphasize the importance of accurate record keeping, not just for compliance but for informed decision making. I would then offer tailored solutions, such as implementing a simplified bookkeeping system or providing training on best practices. My goal would be to foster a collaborative environment where the client feels supported in improving their accounting processes. Now let's tackle another important question. What controls would you recommend to reduce the risk of errors in revenue recognition? I would suggest implementing a robust internal control framework that includes regular reconciliations, clear documentation of revenue transactions, and periodic reviews of revenue recognition policies. Additionally, I would advocate for the use of automated accounting software to minimize human error. These measures would not only enhance accuracy, but also build trust in the financial reporting process. As we wrap up this insightful journey through advanced articleship interview questions, I hope you found valuable tips and strategies to tackle the challenges ahead. Remember, interviews are not just about answering questions. They're an opportunity to showcase your knowledge and passion for chartered accountancy. Each question, whether about substantive analytical procedures or revenue recognition policies, is a chance to demonstrate your expertise and critical thinking. If you found this video helpful, don't forget to like, subscribe, and share the Finance Kida YouTube channel. Your support helps us create more content tailored to your needs, ensuring you're well prepared for your articleship journey. Stay tuned for more videos where we'll dive deeper into various aspects of finance and accounting. Together, let's navigate this exciting path to becoming successful chartered accountants. Your future in finance starts here, and we're thrilled to be part of your journey. Thank you for watching.